Hey guys, it's Fred again, and welcome to The Hobby. A lot is really happening right now. A new stimulus package being negotiated, volatility before the presidential election with Donald Trump even contracting the pepperoni, and even renewed scrutiny towards certain large tech companies and people performing strange rituals. Hey there, did you know that you can sign up with Webull and receive 2 free stocks, each valued up to $1,600? And with Robinhood for another one? Sign up using the links in the description. Did you guys just hear something? Cause I could have sworn Anyhow, for this video, I thought it'd be helpful to share my take on the current climate for investing, as well as my top 5 stock picks for the month of October, as well as going into and even a little beyond the election. By the way, I'm just a regular guy on YouTube who invests as a hobby, as my channel name implies, although I still am trying to profit from it, obviously, and protect my wealth. But anyway, these opinions I'm about to share with you are merely my own, and these stocks I'm looking to potentially purchase are also based on how I'm personally trying to round out my portfolio, and whatever you decide to invest in should be based on your own research and criteria. Speaking of criteria, before we dive into today's stock picks, here are my personal criteria for these stock picks, as well as more broadly how I pick stocks and invest in general. First, I want to invest in predominantly blue chip stocks, meaning those of large, established, relatively well-known companies. My second major criterion is that these companies should all be well positioned in some ways to capitalize on sort of upcoming world-changing trends such as 5G and working from home. And to add to that, my third criterion is that there should be some kind of unpredictability to these companies in the sense that they have a relatively higher potential to come up with something explosively popular that could wow consumers that hasn't yet been priced in by most analysts and investors. After all, stock prices are all about what are and aren't priced in. Starting off with my first stock pick, and at its current price I would consider it more of a growth play, but I still think it's quite attractive for reasons I shall go into shortly. And that stock is Microsoft, ticker symbol MSFT. Now, besides its more well-known ventures, which include the Windows operating system, Microsoft Office, PC accessories, tablets, the Xbox, and associated gaming content, its cloud segment is one of the biggest and fastest growing in the world, providing various cloud-based business solutions for businesses of virtually all sizes. Also, very notably, and an aspect that has become especially relevant as of late, is that you may have heard that House Democrats have recently been scrutinizing and trying to curb their nearly unchallenged dominance of 4 tech giants over concerns of essentially monopolizing everyday things that have become integral to people's lives. For example, such as internet search, which has been dominated by Google, and e-commerce, which has almost become synonymous with Amazon. And to round out this list, alongside Google and Amazon, are Facebook and Apple. And what has been proposed include banning these companies from making so-called anti-competitive acquisitions and buyouts of smaller companies, and even splitting them up into smaller subsidiaries, such as having Instagram split off from Facebook. However, one big name that is significantly not on this list is indeed Microsoft, even with the second highest market cap of any company in the world, only after Apple. Plus, they've also been able to steer clear of all the recent antitrust hearings leading up to these proposals. And this is definitely not the only reason I have Microsoft as one of my top recent stock picks, and also one of my larger current investments. First, let's take a brief look at its stats. So here we have Microsoft, ticker symbol MSFT, at $209.83, which is significantly higher than its March lows. It's currently got a market cap of $1.59 trillion, a PE ratio of 36.43, which is a little bit on the expensive side, and an annual dividend yield of 1.09%. Its forward PE is 31.06, PEG ratio 2.42, price to book ratio at 13, and then its profit margin is 30.96%, current ratio is 2.52, and quarterly revenue growth year over year is 12.80%. Finally, looking at what some analysts have to say, on average it's got a recommendation rating of between a strong buy and a buy leaning towards the buy, with an average price target of $229.83. Microsoft is one of those companies that has continued to grow despite the Roni, especially their intelligent cloud services, which has grown 27% in quarterly revenue over the past year, with their Azure platform growing about 60% and looking to be positioning quite well with the whole work from home trend that is happening. Not only that, but adding to these already impressive numbers is the fact that Microsoft has been working on integrating 5G into its services, which can speed up transmission rates by multiple folds and lower latency significantly, resulting in greater cost efficiency and lower capital investment, such as by entering into a partnership with AT&T to share and co-innovate in the space, and acquiring network provider Affirm Networks, and not even stopping there with the sheer amount of deployable cash that they have to acquire even more businesses. And speaking of acquisitions, although they were regrettably not able to acquire TikTok, but on the gaming front, in which they already have a fairly strong foothold with the Xbox series of consoles as well as proprietary games, they also have recently acquired ZeniMax Media, the parent company of Bethesda Softworks, which develops extremely popular, pop culture defining, and very profitable game franchises such as the Fallout series, the Elder Scrolls series, and the Doom franchise. Not only will this undoubtedly help them against their main gaming rivals Sony, whose PlayStation is well known for having generally superior console exclusive games, although I do enjoy Halo, but Microsoft is also doing something different with their business model for their next generation Xboxes, which are slated to come out later this year to compete with Sony's PS5. Which, aside from just selling their consoles for a one-time purchase, there also is going to be the option to get the consoles alongside the Xbox Game Pass, which includes both the hardware as well as a subscription to hundreds of games, all for either only $25 per month or $35 per month, depending on whether you want the more basic Xbox Series S or the full-on Series X, respectively. Getting back to the ZeniMax and Bethesda acquisition real quick, I believe this also opens Microsoft up to not only a more attractive Xbox, but also significantly more PC market share as well, which actually makes up a large chunk of the gaming industry. And I also believe that alongside 5G and working from home, gaming is also an industry that is on the cusp for a lot of growth and breakthroughs in the near future, with these new consoles and technology such as 5G, AI advancements, and virtual reality enabling new games to become unprecedented entertainment experiences. And with all that said, I would consider Microsoft a buy, although I definitely won't be going balls deep into it yet. Although I will likely pick up some shares to do something similar to what I like to call my version of dollar cost averaging, as I am speculating a dip in price, preferably to around $200 or so, especially due to some recent news I've seen regarding big tech in the Nasdaq index being propped up in a major way by so-called whales, especially Japan's SoftBank, which has been purchasing call options in big names with impunity, and thus driving up prices as contract sellers are actually buying shares to essentially cover themselves in case these contracts get executed. Moving on to my second stock pick to further capitalize on the gaming trend, and also because being a gamer myself, I tend to be more exposed to it and thus understand it quite well, we have Activision Blizzard, ticker symbol ATVI. It's what I would consider one of the big three PC game developers alongside Electronic Arts and Take-Two Interactive, although it very much has reach beyond PC gaming, as I will explain shortly. Taking a quick look at its stats, Activision Blizzard is currently trading at $78.47. Its market cap is $60.57 billion, 33.52 for its PE ratio. Its annual dividend yield is 0.52%. And then its forward PE is 25.71, PEG ratio 1.85, price to book ratio 4.57. Its profit margin is 25.94%, current ratio is 3.02, and quarterly revenue growth year over year is 38.4%. And finally, checking out what the analysts have to say, it currently has an average buy rating with a price target of $95.30. Now, the reason I quite like and already own quite a few shares of Activision Blizzard is that I believe they have a very high chance to surprise analysts with explosive growth across not only already established franchises such as Call of Duty, but also with several new flagship franchises and games, including greatly furthering their expansion into esports as well as mobile games. For instance, speaking of Call of Duty, One of the latest installments in this extremely popular franchise, Call of Duty Warzone, has actually surpassed Fortnite according to a poll of teenagers. And although one can scrutinize the sample population as well as how profitable that game actually is, but based on how much the company has actually grown over the past few years, there's no denying that what they're doing is indeed working. And I do believe that they have a strong moat in terms of the popularity of their franchises like Call of Duty, Candy Crush, which they also own, and more PC-oriented games like Diablo. And although Activision Blizzard has been relatively quiet in the last 2 years, as they haven't put out any major releases, one of the main reasons that I prefer them over some of the other game developers is that according to the president of Blizzard, which is arguably the primary subsidiary of Activision Blizzard, hence the name, they currently have more projects in the works than ever before. This on top of the fact that they've been doing some restructuring and rebudgeting very recently, in my opinion, adds quite a bit of bullish X factor to the company due to the amount of stuff that's actually being planned for and brewing internally. And because of the unpredictability of these factors, as an analyst don't really know how to guide for them, and with us probably guide more conservatively, I don't believe they have completely been priced into the stock. Not to mention, the gaming and esports trends will continue to grow into the future, as I've stated before, with video game sales up 37% year over year in August, which is why I think Activision Blizzard stock still has significantly more room to run in the upcoming years. On to the next stock, and I would consider this between a growth and a dividend stock, as I have been on the hunt for more dividend stocks for my portfolio as of late. And by the way, all the stocks I have on today's list do pay out a dividend. But anyway, the next stock on my list is actually the chipmaker Intel, ticker symbol INTC, which is again a tech stock, but one that is, in my opinion, not nearly as caught up in the ridiculous rise in tech stock prices since March. In fact, it has dropped down to around its March 2020 lows, but in a bit I'll explain why I think it's still a good investment at this price point. First, taking a quick look at Intel stats, it's currently trading at a price point of $52.67, its market cap is $224 billion, PE ratio is 9.68, annual dividend yield is 2.57%, and its forward PE is 10.25, PEG ratio is 1.69, price to book ratio is 2.55, and then its profit margin is almost 30% at 29.97%, current ratio 1.98, quarterly revenue growth year over year is 19.5%. Looking at some analyst ratings, it's currently got an average rating of hold, with its average price target at $56.5. Now, the main reason that Intel stock has seen this recent beatdown is that its rival chipmaker AMD, in a partnership with juggernaut Taiwan Semiconductor, ticker symbol TSMC, has already begun production of essentially the next generation of chips with a 7nm node, whereas Intel's production schedule for a comparable product has actually been delayed. And so this has led to people believing that and betting on AMD actually taking significant market share from Intel, and they have indeed begun to, hence the recently skyrocketed prices of both AMD and Taiwan Semiconductor. And although I do like both AMD and TSMC, if we actually compare their current valuations, I do think that Intel at its current PE is currently a better and less speculative deal, especially as a dividend stock, which is what I've intended to invest into in the first place. Plus, even without getting into the 7nm market immediately, if you look closely at their revenue streams, it's actually the case that even their older processors have continued to see a decent amount of demand. Plus, Intel is actually a very well-diversified and well-established company with a history of executing share buybacks and with a healthy balance sheet and profit margin, especially when compared to a growth play like AMD. And even then, Intel still boasts a relatively strong earnings growth at around 20%. Moreover, they're also involved in AI, autonomous vehicles, 5G integration, and quantum computing. So I would say that they're also well poised to capitalize on these upcoming sort of world-changing technologies. And if and when they do start manufacturing their 7nm nodes in 2022, as they have projected, given the strength and scale of this company, I wouldn't be surprised that they can actually take back some of that lost market share or at least maintain very competitive with AMD. And in the unlikely case that they do lose more than anticipated, even so I still believe Intel to just be an incredible value right now for what it's worth. Not to mention, they do pay out a decent dividend at 2.51%, which has also grown 5 to 7% per year over the past few years. And so for me, I see Intel as not only a relatively safe and reliable dividend stock, but also one that does have that potential to grow as well, as per my general stock picking criteria. Going on to stock number 4 and my last tech stock on this list, although this one is also more of a value play similar to Intel, and it's Cisco, ticker symbol CSCO. It's one of the largest network infrastructure vendors in the world, meaning that they are very much involved in 5G and are even fairly established in the web conferencing space as well as the cybersecurity space. Taking a quick look at some of Cisco's statistics, it's currently trading at a price of $39.40, which is slightly higher than its March low, and its market cap is $166.8 billion, its PE ratio is 14.92, annual dividend yield is 3.73, which is quite high, and its 4P is 12.8, PEG ratio 2.56, price to book ratio 4.4, and then its profit margin is 22.75%, current ratio is 1.72, quarterly revenue growth year over year is negative 9.5, but its quarterly earnings growth is 19.5. Looking at some of its analyst ratings, it's currently averaging a buy rating with the average analyst price target of $48.17. Now, of the more direct 5G plays I wanted to be exposed to, having taken a look at quite a few options such as wireless and data providers like T-Mobile, I decided to prioritize Cisco at its current valuation because of, again, a fairly low P of 15.07 coupled with a good dividend yield of 3.62%. Growth-wise, on paper, it doesn't seem as strong as some of the other companies, with its revenue even declining slightly in recent quarters, especially with the pepperoni situation making people work from home, and thus there being less demand from businesses, especially smaller ones, for on-site, in-office network infrastructure. However, as with my other stock picks, I actually believe Cisco is not only a huge name that is of great value right now, but also a company that has some surprise potential as well with its recent cloud service related acquisitions and investments into 5G. First of all, from its long-standing brand recognition and the reputation it has maintained throughout the years, Cisco should continue to be one of the leaders in providing business-to-business network and telecom equipment, especially with the advent of 5G and the inevitable upgrading that many businesses and areas will be undergoing. Moreover, I believe that Cisco has several more things going for it. Of note is that one of its major competitors in the 5G infrastructure space, China's Huawei, is currently facing a lot of sanctions and scrutiny from major countries including the US and the UK. Also, Cisco doesn't just have its network business, 5G, and the cloud going for it. Its web conferencing software known as WebEx, which is a competitor to Zoom, has actually been growing quite rapidly as well. And having used it myself in my previous workplace, I definitely vouch for its usefulness and user-friendliness for business. And although its biggest competitor, Zoom, has grown even more, especially among more casual users, it too is facing scrutiny from governments and enterprises for having security flaws such as meetings being listened on or hijacked and things of that nature. As such, for example, Zoom is currently banned for official business use by the Canadian and Taiwanese governments, as well as by SpaceX and NASA. Speaking of which, to add to my case, in terms of web conferencing as well as 5G, I believe that business applications as opposed to more everyday applications is where their capabilities will be utilized to their full potential. And I think Cisco is well positioned in that regard, which is why I'm adding it to my portfolio as a stock with growth potential that is also fairly valued and pays out a healthy dividend. Finally, onto my final stock pick of the day, and rest assured it's not a tech stock because it's the pharmaceutical company Pfizer, ticker symbol PFE. Going over to its stats, it's currently trading at $36.47, which is a bit higher than its March lows, but not as high as its pre-March highs. And then its market cap is $202.66 billion, PE ratio is 14.44, annual dividend yield is 4.17, so quite high there. And its 4P is 11.76, PEG ratio is 2.37, price to book ratio is 3.12. Its profit margin is 28.81, current ratio is 1.72, its quarterly revenue growth year over year is negative 11%, and finally, looking at some analyst ratings, it's currently got an average rating of a buy with an average price target of $41.67. Again, Pfizer is what I would consider a value, big name dividend investment with the potential to grow tremendously given how it's positioned to capitalize on a huge trend. Namely, with the Rona going on, Pfizer, partnered with German biotech company BioNTech, is actually the forerunner in developing approved Rona-virus treatment. Even Bill Gates, who is heavily invested in the healthcare sector, thinks that Pfizer is the clear leader in the race, with some saying that it could even be a couple of months ahead of its competition. And in the likely situation that they win this race, as well as secure emergency use authorization from the Food and Drug Administration, as well as supply deals with other countries, this could bode extremely well for Pfizer in terms of establishing a foothold in this area, especially if this virus persists into 2021. Not that I'm trying to jinx anything. And even if things don't end up going too well for Pfizer in this regard, which frankly seems pretty unlikely at this point, the company has already been able to streamline their existing line of pharmaceuticals by divesting some of their older, less profitable drugs into a merger of one of its units with another company, meaning that the portion of Pfizer will actually split off in the merger to form a new company called Viatris. Which, if you buy Pfizer shares right now, some of it will actually also become Viatris shares when the merger completes, in the same proportion that you originally owned it, by the way. After which, you will have two different stocks, both dividend paying, that you can then decide to sell or keep, whichever ones you decide to. And those are my top 5 stocks for the month and going into the elections. Let me know in the comment section below what you think of them, or if you have any other stocks or investments on your radar, and I'd be happy to share and exchange opinions and insights with you. Anyway, thank you guys so much for watching. Like the video if you liked it or found it helpful. Pick up 2 free stocks from Rebel, as well as 1 free stock from Robinhood using the links in the description. And remember to subscribe to my channel for more videos about investing as a hobby. And with that, I'll catch you in the next video. Peace.